6 reasons the stock market could crash in 2021. In 2020, stock market investors witnessed a decade of volatility fused in a single year. It was one of the most unprecedented stock market year ever seen. It was characterized with sharp declines in the early months of the year and massive rebound in the latter months. This can be attributed to the COVID-19 pandemic that built up uncertainty in the first 4 months of 2020. In fact, we witnessed record point gains and losses in the Dow Jones and S&P 500 average indexes. All this volatility was unexpected in the months leading up to the coronavirus outbreak at the beginning of the year. That's how hard it is to predict what to expect in a certain year. No one could have told you that in Q1 and Q2 of 2020 would be extremely bearish and that the latter 2 quarters of the year would see double-digit gains. Although 2020 is a testament of how almost impossible it is to predict market movements, we could still refer to certain indicators to improve our prediction accuracy. So, what indicators should one look out to predict where 2021 might go? In this piece, we look at those predictors and assess the reasons we could see a stock market crash in 2021. Number 1. Escalation of COVID-19 effects. COVID-19 was the significant contributor to the 2020 stock market crash. Although there have been new solution developments, there are still lots of unknown. Recently, there have been discovered new strains of the virus, adding up to the uncertainty on where the global economy might head. If the worst happened, we could see a repeat of 2020. A second wave of the virus could see more induced lockdowns. This is a concern for the coming political leadership and also for the market investors. A possible lockdown would affect all key consumption and financial industries that form the stock market backbone. We could see mass unemployment that translates to less consumption and eventual crash of certain products-related stocks. The new discovered variant virus has also added to the uncertain atmosphere. SARS-CoV-2 virus, which is the primary course of COVID-19, has been found to mutate. Its mutability means that it could turn out for even the worse. Fears of more complex transmission and more deaths would force the government to come up with tougher restrictions. Tough restrictions would translate to devastating economic repercussions. Stock market investors are observing this and may be reluctant to take a position. Those with open positions may decide to short them. If this happens simultaneously as it happened last year, then we could see a potential crash. The crash might even be bigger than 2020 as people would be scrambling to take profits realized from later last year. The fear of unknown caused the S&P crash in March, and history could repeat itself this year. Number 2. Possible vaccine issues. The last few months of the last year saw positive news about possible vaccine developments. Pfizer and biotech companies had developed vaccines with over 94% effectiveness. The news substantially contributed to the stock market rise. However, the euphoria could evaporate instantly if SARS-CoV-2 fears are true. The new variant may mean that the discovered vaccines that caused the market to crash are somewhat ineffective. This may cause a significant plunge in the stock market with worries of possible lockdowns and restrictions. Another threatening statistic that could threaten the return to normalcy is the drop in number of people willing to take the vaccine. According to Pew Research Center, the number of people likely to get vaccinated had fallen from over 70% to 52%. Those who really wanted the vaccines had also reduced by half from 42% to 21%. These stats show that we are far from returning to normalcy, a negative indicator for the stock market. Even if the public shifted their attitudes and welcomed the idea of new vaccines, several issues could still occur in the vaccination process. For instance, a research done by Dr. Anthony Fauci showed that 70% to 95% of the US population would need to receive the vaccines to develop what is called herd immunity. It is also impossible to get all those people vaccinated within a year, thus slowing down the return to normal. Furthermore, the distribution process could be a challenge for the country. For example, the discovered vaccines have demanding storing requirements requiring to be stored below 100 degrees Fahrenheit. For the vaccines to have a positive impact on the stock market, the whole process has to be flawless. The approval, distribution, and administration process have to be perfect. This is almost impossible, thus raising concerns for a possible bearish year. Number 3. Bearish market sentiments. 2021 could see a negative market sentiment leading into a bearish year. Market sentiment often indicates market atmosphere and the general feeling. Positive sentiment is consistent with a bullish market, while negative indicative of a possible bear market or even possible crash. Market sentiment is often a mix of several things, but more often about political developments, geopolitical environment, and Federal Reserve plans. On a technical level, Sediment is traceable to consumer price index, inflation, and interest rates. In 2021, negative sentiment may be traced to a huge government deficits of 2020. Huge deficits often attract higher interest rates and a strong indicator of a possible bad market. Furthermore, unemployment levels can also be used to predict where the stock market might head next. Due to increased unemployment rates of last year, investors might have a negative feeling about the market setting it up for a possible crash. Sediment is usually a reflection of market emotion. It can be challenging to predict human emotions since it's subject to rapid changes. The only thing one can do is to look out for possible emotion triggers and predict the current or future feeling. To assess a possible market crash in 2021, one might look at the following market sentiment measures. The VIX. It is usually referred to as the fear index. It can also be used to measure possible volatility in reference to traders' emotions. When the index is high, it illustrates a possible volatile market due to the high levels of uncertainty. At these high levels, the market swings can swing sharply on either side. However, when the index is low, it is an indicator of calm and less possibility of drastic pumps or dumps. The VIX index has been sometimes going above 19 levels, which is the average valuation. Stock short interest. Investors shorting is indicative that they are anticipating a possible drop. If it drops, they make a profit. Short interest number shows the amount of shares that have been shorted. High percentage of shorts show that the investors are pessimistic of a possible market rise. However, you need to combine the short interest indicator with other measures to come up with a conclusive decision. This is attributable to the ironic nature of short interest. For instance, a high short interest may also indicate a possible bull market. It means that a lot of investors have shorted their positions and may need to buy back when the market starts to climb, causing it to rise even more. Currently, the short interest is in the middle range, but this may change at any moment. Moving averages. Stock market traders can also refer to the moving averages for different periods. They can compare a 50-day moving average with a 200-day moving average to assess market sentiment. When the simple moving average SMA of 50 days is higher than that 200, it shows a positive sentiment. Currently, the 50-day SMA is slightly below the 200-day indicative of a negative sentiment. Number 4. Political uncertainties. Just like the case with COVID-19, uncertainty often comes with a bearish sentiment. Politics and new administrations often contribute to the uncertainty element. With a new president, Joe Biden, the stock market is uncertain on how he will handle certain issues. One issue they are looking at is Biden tax increment recommendation. He recommends an increment of corporate tax from 21% to 28%. This would translate to over 7% decline in corporate earnings and consequently lower returns on investments. Lower returns on investments will discourage investors from taking positions, waiting to see how the market reacts once his recommendations become law. Although less influential as the tax bill, investors are also looking at Biden's geopolitical strategy. They are uncertain on how the new administration relationship with other key countries will go. How he handles China or Iran or global pandemic issues is still uncertain to many, making investors conservative in taking positions. There is also an unknown issue of possible stimulus packages in the future. Past stimulus packages from the last administration triggered the bull market, and little is known whether President Biden would take similar approach. Considering the president's economically conservative nature, some investors are skeptical if he would offer such a boost. Number 5. Unhealthy concentrated gains and high valuations. Ask any experienced stock market investor and they will tell you that the importance of having a healthy market breadth. A healthy breadth is an indicator that the economy is actually performing well. It eliminates fear of a stock market bubble that may burst along the way. This breadth has not been the case in the start of 2021. The stock market has either been dominated by one sector or a few large companies. Tech companies like Apple, Facebook, and Amazon have outperformed other companies in an unhealthy manner. It also is critical to point out that these tech company markets' capitalizations are often overvalued, and in cases of corrections, they may come with big market dumps. Also important to note, technology innovations have attracted young retail investors. Existence of trading apps has allowed retail investors with less capital to participate in stock market. Previously, high transaction costs and procedures prevented these investors from trading stocks. Fortunately, these applications have allowed them to invest in stocks and particularly technology-related stocks. The unfortunate scenario is the possibility of a huge market correction in 2021 from an unhealthy rise in late last year. If that happened, it could cause panic among these retail traders followed by massive dumps. It is possible that this could happen in a simultaneous manner and that could have a devastating impact on the stock market. Number 6. Overwhelming loan and credit delinquencies. Financial stocks form a substantial part of the American stock market. Due to COVID-19, these stocks are at a rise due to loan and credit delinquencies. These would arise from huge unemployment rates from last year. The possibility of a possible lockdown in 2021 would put people out of jobs, unable to pay their mortgage, car, and other loans. House vacancies and foreclosures from people unable to clear their loans is also a possibility. If this happened at a larger scale, then this could spell disaster for the financial stocks. Considering that the 2008 financial crisis came from the housing market, investors will be looking out at how this will be handled. If investors spot mass mortgage loan delinquencies, then this could force them to liquidate their position. Although less likely, if they decide to sell their positions at the same time, then this would be catastrophic for the stock market. The bottom line. So, is it an eventuality that the stock market will crash in 2021? That's always hard to tell. We can only look at the signs, warnings, and indicators to make a conclusive decision. By watching this video, you can see the high-risk factors you should look out for. As already seen, there are signs of a bearish stock market in 2021. However, you should always be prepared for multiple possibilities. To prepare for a possible crash, it is always advisable to have some cash on the sidelines. Crashes often come with amazing market entry opportunities that you can always capitalize on.